and I'm going to show you my charts. Ciao Alberto, come va? Screens. Let me see. One more second, okay? Screens. Right into let's try this one. Go live. All right, so you should be able to see my chart. Let's talk about. So first of all, you guys have any questions about anything that you want to me to discuss or we should discuss? Alberto, how are you? Hey, okay, okay. Yeah, so it's a pretty good day, right? We had a very nice run up, almost 92,000, but it's amazing. Actually, 92,800. Wow, very cool. Um, yeah, I hope this continues, So this is what we were waiting for a long time, right? So let's look at the chart, a few charts. So we have this one where we discussed a few times, right, in our shows, etc. We say it was unusual, right? So to kind of summarize what is happening right now, it's too early because we are having this crazy rally in the last couple of days. So we have to see if it continues, etc. But in general, right, the idea is let's put it in a context. So the first thing, right, if we want to say, okay, uh, we were supposed to have our normal cycle starting November. We actually predicted that it went exactly like we said, right? We even got it was partially based on the power law, but also luck, right? So it's crazy if somebody says they can predict anything about Bitcoin within few dollars, right? It's crazy. I did get it right, 93,000 at the end of the year, but I hear a ringing. That means the bot is selling something. Um, that is nice. Anyway, so right, and then we had this very nice rally. We went to 108. We entered this red region, right? That according to this indicator, paints every 4 years. And usually, once we are above it, power law general direct, general line, right, the blue line, we stay in that region for about 2 years. We never leave it. There was just one exception. It was 2 cycles ago where we briefly dipped right here and then we recovered, right? But it didn't last very long. And in fact, once we recovered, it was kind of explosive, right? It was almost like bounce back from that, going back to the green area. So the green area is when we stayed, between the support line, with it, with this line that we never break, and it's about 60% from the blue line, and the green color here expresses more or less what we are supposed to see. Basically, we stay in this region, and we can deviate from it when, for example, the way to understand the bottoms are like a deviation from this kind of middle ground between the support and the uh, in the blue line. We are kind of supposed to stay there, right? We call these, now our terminology for this, we call it the power law core. This is where we spend about 2 years, we stay there, we follow very, very closely the power law. We can have deviations in both directions. When we correct, right? When we added this deviation, mostly due to the FOMO associated with the ETFs, we touched the power law, then we corrected. We went from 72,000 to about 50K. Then, we did have the beginning of a cycle exactly like it was supposed to be, right? Then, during that time, I was reporting that the main difference was I didn't see much global liquidity because we had also these global liquidity indicators. I was not too much convinced about this delay thing. Now I'm converted, right? Because different people contribute, and when they contribute something useful and it's true, I accept it. If the evidence supports it, it's not that whatever other people do, I don't agree. It's the opposite. It's everybody can contribute, right? So when I went and checked it in the beginning, I was skeptical, and then little by little, the evidence made me think, yes, this connection is true. And now we even have an indicator, right? We can look it up that shows the delay between global liquidity and the Bitcoin price. But even then, right, I was saying, look, liquidity. So there was a period where liquidity was going up, the price was going down during this 55K, right? And it was cool. And then they started to do the opposite. Liquidity went down and the price went up. And they say, okay, this is not good because I was expecting them to cross at a point and then go up together during the bull run. That is what happened every single time in all the other cycles. And this was different, right? And if I studied, if I actually took seriously that delay, then we could have interpreted that as a correction, that we were going to have a correction, right? And in all honesty, I was worried, but at the end, go all the way and say, oh, we're going to have a correction this, because of the liquidity, global liquidity is going down, and the price will follow. But the same that what happened, right? Plus, in addition, we had a. I'm not sure if people were anticipating. Part of the explanation was that maybe people were anticipating the tariffs, right? Because the people that study these things, or institutions, maybe nobody could be sure of it. Trump was going to be elected, but once he was elected, or maybe even before, when it was probably obvious that he was going to be elected, they kind of reacted. It's possible, right? It's a possible interpretation. They kind of, um, they were not. In general, even if you didn't predict who was the winner, the fact that it was an election could create uncertainty, where you know basically liquidity is not up and is not growing because people are afraid. The worst things for a market is not it's not when things go bad, but when there is uncertainty. Uncertainty is the worst thing, worse than when things go bad. Because at least going back, you can always factor it in and have an idea of what to expect. But when you are uncertain, it's the worst things for market. They react very bad, and so the liquidity was going down for a long time, right? And now we are seeing a couple of things. First of all, I think that people are starting to get used to this idea of tariffs. There is still a lot of uncertainty, but we talked for a long time about how good it will be if Bitcoin was decoupled, or in fact even anti-correlated with the stock market, and be something that people consider as a way of escaping, uh, bad situations in the stock market, like basically a store of value, an edge against uncertainty. Like people consider gold in that way, and it's nice that at least in this instance we will see how long it lasts. But it seems exactly what is happening right now, right? So let's see where it goes. If we go and check our charts with the liquidity. Let's see if I have it here or somewhere else. So let's look at the chart. I will close down this one. I have it somewhere else. Let me share the other one. Okay, this one. All right. So this is a this chart with is actually a new indicator, and if you don't have this indicator and you're an insider, please let me know. I will add to your list. But I already described this chart a few times, but I will try to make a video. I want to make a video for every indicator. Probably I should start with the newest ones because people don't know about them. But it's relatively straightforward. But having a video is always nice. But basically, this is how it works, right? So I don't know if there are bars, but let's see if we can make it more clear by using a line, maybe. Then we can make it settings. Why settings doesn't appear? Settings. Trying to make it larger and easier to read. It's not working. Why? Oh, let's start this. Okay. Usually, when I click here and say settings, it should show me a way of the colors, etc. I want to use a okay, but whatever. I don't know why it's not working. Maybe because I have too many things open. I don't know. All right. So, but you see the white line? It's Bitcoin price. So let's zoom in, maybe. Right. So this is Bitcoin price, and the purple line. So there are two lines for this indicator. One is the green one, and then the purple line. So what are they? I use the relationship between M2. Now, you could use something more sophisticated in terms of global liquidity, and we can. But I tried offline a couple of combinations, and it doesn't. You don't really get too much more information that you get by simply using um, M2. And M2 is relatively simple to get, so I stick with M2. But we can explore more. But even just using an M2, you can plot. I did this offline, and the M2 price relatively to M2, and then you find there is this very nice power law. Now, if you go too early, and I can show you that, right? If you go too early, then the power law breaks because the relationship between M2 and the price is more complicated over the long term. It's some more complicated equation than a power law, right? A power law means you plot the log of the log of a liquidity. It's measuring whatever, right? You can always convert it in dollars, right? Of course, it contains all the other currencies, but the way you do it, you convert these currencies in dollar equivalent, and then you sum them together to give you the total, basically kind of a measure of how much money is moving around right now in the markets. If you go all the way, to the early history of Bitcoin, you can see that this model breaks, right? Because you see how big of a difference, like Bitcoin is curving like that because it's a power law. If you are in a graph like this, we mentioned so many times, right? That is basically we are taking the log of the y-axis and we keep the x-axis linear because it's it's not easy. You in theory you could do it by using some code, but it's not natural for TradingView to have a log of x, log of time. It can do the log. See here, I can do the log of x, y, but not the log of x. But if something is straight, in fact, this is why I draw this blue line. You see how the global liquidity is pretty much a straight line, right? Which, of course, it's never perfect, but it follows a straight line. That means over the long time, it's an exponential. While Bitcoin is curving like this, that means it's not an exponential. But if you focus on, it's basically 2014, I think. So if you use data up to 2014, so more than 10 years, right? Or a little bit more than 10 years, then it's much simpler and the two match very well in a log-log graph. It's an approximation, right? So the question, because that will be interesting, to see what is the real relationship. I mean, I tried to make a model like in the other indicator we have that is like a polynomial. When basically you don't know what the real relationship is between two things, because this is why you always try to find something simpler, right? First, maybe they are linear, maybe there is an exponential relationship, maybe there is a power law. The equations are much simpler. If the relationship is much more complicated, then you know one of the most used approaches is this thing called a polynomial expansion. Basically, you add more and more term with x, x squared, x cubed, x four. And it turns out there is such a mathematical theorem. It's called the Taylor uh, expansion. Uh, that you give me any complicated equation, I add more and more of these terms. I can always approximate this complicated behavior. There's even noise, by adding more and more terms to basically unlimited level of precision. The problem is if you're trying to find a relationship with also for the future, you want to generalize, right? Because if you start to add more and more term, you're approximating the past and not the future. The entire idea of making a model that works also for the future, that can be used for making projections, is that there is some kind of underlying relationship beyond the noise that will continue to exist also in the future. That this is why we like the power law in time, because it's supposed to be pretty universal, and so then you can project it in the future. It's not just what happened in the past, right? If you start to add more and more terms, basically you're doing what is called overfitting. You're taking a snapshot of the past, but there is no guarantee you are extending in the future. This is something that I wish people understood better in terms of what we can count, in terms of making projections and what we cannot count on. But this is why the power law remains unique, because the idea is it's a simple relationship as held from the beginning, and probably something deep about how Bitcoin works, and so we can project it in the future. This one between the the price and liquidity, it's a different status. It's much more, let's say, provisory. It's kind of a rough relationship. It's an approximation. So I don't know how much we can project it for the future. Maybe locally, maybe on a short horizon, but it's not something. It will be in theory. We could take these the growth of liquidity over time that is supposed. It seems like an exponential, so we could project it. The problem with it, in projecting exponentials is not as universal as projecting power laws, right? They are not reliable because the rate of change can change, etc. That is the main problem. Because otherwise, we could use it also as a predictive tool over the future, right? We saw there is this relationship. So I think probably what happens, right, if you want to project it to the future, is that probably the liquidity will continue to grow more or less according to this blue line. So we can even project what will be in the future. Um, but its relationship with Bitcoin will change. So, right, for example, if you plot on a log chart, you can see that it's curving and is flattening out. So instead of being a straight line, that means that probably over time this relationship between the power law and the liquidity and the price is changing. So it's becoming less efficient. Right in the beginning, a small change in liquidity could create a huge big change in the price, and it's still big because right now, if you use the last 10 years, it's a power of 9.2. That means I think I did a calculation of only a 10% change in liquidity creates two times the price. It's crazy. But I don't know. I will try to do some study like that. I was already thinking about can we project it really in the future, right? Maybe 1 year ahead of us, 2 years. We can try. I will know. I will take it with a grain of salt, though, right? But it's something that we could try. But what was interesting to me, because for some time I was very skeptical, was also these local features, right? Because you can see it's not always one to one. Because see here, for example, we have a peak here and the price peaked here, right? So actually, in general, it seems there is always some kind of a delay. So the price for Bitcoin peaks early, then liquidity peaks. While the bottoms, like look at here, right? Nice matching of the bottom here. COVID, it's not. This is interesting, right? You see how COVID happens here and then happens here, and you say, what is going on? How can it be that COVID affects? We are shifting everything by 85 days here. So here we match because probably the bottom happened first in the liquidity, and then later affects Bitcoin, right? Here they happen at the same time because COVID affected all the markets at the same time, including liquidity. But because we are shifting, it looks like it's in the future, right? But it's simply because we are shifting. Now, this is actually is something that should have happened at the same time, but because of the shifting, it looks it's happening two different times. But those have a real delay, and when you account for the delay, then the features match, right? But the peak we don't match because probably it always happens before because we are decoupled, right? Most of these craziness is due to FOMO. So they start together, and then they continue to go up. Liquidity goes up, uh, the price goes up for Bitcoin, but liquidity then doesn't go and follow the craziness of a FOMO in BTC, right? It does its own thing. So they are, but I don't know. It's 85 days. We'll have to see. Could you use it to kind of know in advance? Maybe the delay is so big that even with the 85 days, you cannot. Because remember, this will appear first, right? Because there is a delay. So what is the delay here? 16 December and here April. Too long, right? 85 days, 3 months. Yeah. What I'm looking for is, even if there is a delay, could you use the fact that the liquidity is flattening to say, oh, we reach a peak? No, because if you use, even if you use 90 days, right? So it's basically 3 months. So this was, if it happened in March, yes, but it happened in April, right? So it's not useful to be predictive unless it's a kind of confirmation, because by end of January, pro- probably you knew already that we were in a downtrend, right? So but the liquidity flattening here and being a giveaway. Anyway, but the bottoms, they seem to match very well. Like see here, this bottom matches with this, and so on. So it's actually predictive in this case, because by the time you see a bottom here, it's 85 days ahead, so you can use it as a predictive tool. But there is a lot of matching, and this is what this lower graph is trying to show, because and this is part of our new indicator. What I'm trying to do here is, because you see how sometimes they match very well, because see how well, very well, they almost seems to hug each other, right? And you can rescale these arbitrarily. I don't know if in these indicators, you cannot rescale it, but I can add the rescaling if people are interested, because I can rescale this region, right? By rescaling, I mean something like this, right? That right now they are linked to each other, but you could make them independent, where you can, like with two, it will be a small modification. If people are interested, they could do, I can add like a scale here on the left. And then you can rescale the two charts independently. Um, I choose a scaling like this to match with recent features, but you could play around where you can match. Oh, I want to match this bottom. I want to match this other bottom. So you could rescale it, right? So it means that the scaling between the this model based on this power law between the M2 and the price, it's variable, right? So sometimes the scaling here is not the same scaling here, so you can still try to match the features by choosing appropriate rescaling. So to avoid that problem, I say, what about if we count the we do a directional indicator that tell us more, you know, are we going up, are we going down, that is what is more important. And to do that, I created this indicator where basically first I smooth the curve. So basically I'm using the model here, the green model. This green model is a smoothed. Basically, I try to reduce the noise, and so I smooth it. I think I smooth it over a few months or something like that. And so I'm using that smoothed model both for the, basically I'm taking a moving average, right, of both the price and the liquidity model. Where I transform the liquidity into a price, and then I calculated the winning rate. So how many times we go up relatively to many times we go down, expressed as a ratio, and I use a 1 year window. And then you see this, and the blue is the Bitcoin, and the orange is yellow orange is the model, the global liquidity model. And you see they match pretty well. Again, kind of what we say that the tops we seem to be delayed, they happen later for the liquidity. So it's another way of showing what I just showed you. Here it seems that actually, when you look at it in that way, we were like, yeah, there was a peak here, at least in terms of this winning rate. So we actually did match here. And then the bottoms match very well, right? You see here at bottom for the model, bottom for Bitcoin, same thing here. So, but I have a recording system. I need to get a better one with stops every 30 minutes. But anyway, so let's go back here, right? So um, yeah, so basically this is winning rate, right? And you, I don't know why I put this scale on the right, but you see here we have almost like 100 percent winning rate over a short amount of time, right? It because it's muted, so it will look like, oh, we were in a winning strike for a long time, right? And it's interesting because notice how the bottom, how regular the bottoms are, right? They are all happening for Bitcoin. That is another interesting thing. They're all about something close to 20% rate. So when we lose 80% of the time over moving window of 80 of 1 year, that is when we know that we reach a bottom. So it's really cool. If this continues to be true, then again we could use this as another way of determining where the bottom is. I don't know if that will apply to the next bottom, but it would be really cool to see if that is true. We have like a precise value to identify the bottoms because they seem to happen all the same at the same level of winning rate. It's not the case for the tops. This top was more like, for example, this one was more like 87, while this was 100. Um, but the idea here was to show that indeed the features are similar. I calculated that basically 70% of the time when the liquidity model goes up, then the price follows. So it's not one to one. Like people say, oh, liquidity goes up, Bitcoin always follows 70% of the time. I like to calculate stuff, right? It's nice to calculate things because it gives you more confidence. So it turns out it's about um, 70% of the time that actually the price follows. And you can see here the liquidity is moving up. This will be a little bit delayed because we're averaging over a long period of time. So in the next few days, we should see this green with this blue line starting to turn up too. But it's predictive. I mean, it's crazy to have something, even if it is not super precise, it can give you a general sense of a direction. Um, 85 days, 90 days in advance, right? So if this holds, this will be really powerful because we can tell, are we in a bear market? Are we in a bull market? So the two need to, you can see, the bear market, the bull market starts when there is an alignment between these two things. See, here, look at this bull market, price goes up, liquidity goes up. Remember, liquidity goes always up first. Same thing here. Liquidity went up, price followed. Um, Here, notice what happened. Notice here, liquidity was flat, right? And in fact, yes, here we are averaging, etc. But in a certain sense, it was actually going down. But at a minimum, we didn't see. This is what I was complaining over and over again. As I say, oh, how come liquidity is not coming? It's not following. So we went. This was during the ETFs, right? This shows that during the ETF, this didn't happen. Yeah. So let me retake back this. Let me actually explain it better. So this was during the ETF, right? So during the ETF, it was a decoupling, mostly, and this shows it was all FOMO produced by the ETFs. The ETFs push the price up, and it was all his own thing. It was not supported by the liquidity because the long term. And it's not that then is all about liquidity, right? It's not all about liquidity, but for Bitcoin to have long term value, because it's supposed to be a store of value. This is what it does mostly right now, right? Is how people use it. You need money to come from somewhere, right? And yes, there is some retail, and in particular, the early history of Bitcoin was mostly driven by retail, so probably there was less correlation between these two things. But the moment institutions started to play around, um, most of the money comes from the institution. So these big macroeconomic indicators are fundamental. And sure, here's it means that there was some alternative source, right? Like the people that got involved with the ETF, maybe some retailers started to join too because they got excited. All the ETF, all the uh, excitement due to the ETF, but also was a sudden maybe alternative source. All these BlackRock, etc., right, buying Bitcoin and pushing it up, right, because we needed to create the fund. There was not linked to these more traditional sources of liquidity. So there is a disconnection. So it's very interesting to see this, right? And then what happened during this period of time when I was telling you, that I saw this disconnection, right? So what we saw was that, yeah, for some time liquidity was going up, right? This is what I was telling you, and the price actually was going down. It was this during this period of time, and then liquidity started to correct itself because we are taking long averages. The fact that we went up a little bit up during January, it doesn't even show up. It looks like flat almost. But what should have happened? Also, because remember there is this delay, right? So what should have happened is that liquidity continued to go up during a bull market, like here, right? You see liquidity goes up, 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 but it didn't. It corrected itself. So, in insight, if we had a chart like that, we could have said, "Whoa, here something is happening," right? Exactly around mid of January, liquidity is going down. I mean, a few people say that, right? I didn't trust it 100%, right? And they say, "Oh, there will be a correction also on the price." It was not immediate, right? Because for some time we stay there, we stay above the power law, but we didn't do anything. It was just flat. It seemed like Bitcoin was not going anywhere. And then finally, it started to follow the liquidity, and we had this major correction. So, all this to say that if this relationship continues, and we have some sign right now, so, it's too early, it's a couple of days, right? So, is this going to continue, right? Is this turning around? It's basically the price matching what liquidity is doing. I hope so. Right now it looks good. We were waiting, right? That we made posts in the last several days saying this is what it seems, right? Let's hope that really happens. That these two features match, and this is happening right now, right? So now we are allowed to wait in the next few days if it continues, because this thing. So let's say they continue to match, right? We don't know what liquidity is doing next. Let's hope it continues to go up. But even if it didn't, right, and if we just simply follow uh, this leg up that we had seen so far, let's see how big that is, right? So we go from here, that is April, right, today, to July. So mid of April, mid July, April, basically May, June, July. So 3 or 4 months, right? So we even if we simply follow this, will mean that for the next 3 4 months we go up. I take it. One possible interpretation is that this is the bull run that we anticipated, and finally, it has been delayed for a mixture of things because of the uncertainty due to the tariffs. People maybe being scared about this new president doing all these new economical things, and now the market is recovering because two things, right? Maybe they are processing the tariffs and getting used to it, and two, actually the tariff could even help with people moving liquidity towards things like gold and Bitcoin. And so, yeah, let's see. And then now that means that maybe we do have a cycle like all the other cycles, and it's supposed to peak at the end of this year, right? And 200,000, it's over there, right? So let's add a little marker to see where 200,000, because this is what we predict in the past, right? So it still means that, what is it? 200, it's kind of here. No, this is actually 260. Do you like 260? Should we do 260 instead? Let's do a more realistic 200, right? It doesn't seem impossible at all, right? It's still far away, right? We are just here, right? But and if this model is correct, I will not take it 100% one to one, right? So, for example, if you look at this, you say, "Oh, what is that value?" Because remember this scaling problem, that is like more like 130 or something, right? By mid-July, I don't know because, like I say, I don't. The general relationship between the purple and the white is correct, right? If you look at as an average, but here is overshoot, right? In terms of where we're supposed to be. Here we are matching better, but it's on purpose because I choose a scaling that will give me a good match here. But because it's not good here, I will not take it 100%. It's more directional, I will not take it seriously in terms of. That was the initial goal. I wanted to see if I could not just match the direction, but also the scaling of what to expect, right? Uh, if liquidity goes up this amount up, then this will be the price. But unfortunately, it doesn't work very well because the scaling changes. Now, if the scaling stays the same as whatever how it worked since November, right? So it's the scaling that works in this region, then this is true. So if you take it face value, it's like 130,000 by July. We will see. We will have to see if that is true. I will take it more like direction, but 200,000 by the end of the year is not impossible, right? If we continue to go up, so it's pretty good. Yeah. So this is what I have to say about this. Do you guys have any questions or any comment, or do you want to ask anything or comment or correct anything I said or whatever? And if you don't want to talk, you can also write in the chat, okay? Anybody? Sander, how are you, Sam? Okay. Are you happy about this turning around? Hmm. Yeah. So the other thing we can start to look at, if we really have something that goes back to look like a recycle, right? Um, it's not going to be a question of finding a particular number, right? It's more like what are the expected deviations. We have all these indicators, like we can go back to the other one. Let me close this one first. So one good one is the bimodal one, right? Because this bimodal one will give us a feeling of what is. So if you look at the previous bubbles, this is how you will use this indicator, right? So as we start, hopefully we go back in the red region, and then we should be able to see something that looks like this, right? So how will you interpret something like this? Let's imagine this was where we were last cycle, right? You see how there is this red line. The red line is the most likely value. So basically, the power law is always there. It's just that there is some kind of like a consistent shift of where we are expecting the mean average value for the power law during these two regimes. Right? So during when we are in a bull market, because everything is basically one way of thinking is that the power law is always there, but there is more volatility. There is much more volatility, and there's no volatility on both sides because you see how in the green region the volatility is much more uniform, right? It looks like a Gaussian. So there is an equal probability you shift on the right and an equal probability you shift on the left, right? But in general, you stay around this dark green area, right? This line, green line. During the bull market, we tend to have what is called a long tail. So imagine, we use a bell curve, but now is stretched. One of the side is stretched, and which one is stretched? The one towards higher gains, right? So it's much less likely we have a big deviation on the negative side of things than on the positive side of things. But you still have some kind of an average value, and that average value is this red curve. So the red curve is where we spend most of the time, or what is the average value um, during a bull run. So that is kind of our reference, and you can see because it's parallel to the blue line, it's still a power law. So the power law is always there. It's present all the time. It's just that one way of thinking about these bubbles is that there is a huge, big, uh, and I should take it back. Actually, the deviation towards positive value is mostly during the first part of it. So when we actually go up, right? So during the bull run, and the bull run lasts about 1 year. In fact, it could even make sense to split this in two regions, right? When the time when we go up and the time when we go down. Um, so when we go down, we have this very very long tail that favors, right? Gives you the long tail. The way to understand the long tail is this: that if you had a like an equal bell curve, like a symmetric bell curve, very large values for a positive value will be very unlikely. If you have a tail, it means they are unlikely, but not as unlikely if the curve was symmetric. So there is much higher probability. Let's say getting a 10% day or 8% day. If it was a bell curve, it would be maybe 1%, right? If you have a long tail, now it's maybe 6%. So you have still a small value, but not as small as if a curve was symmetric. So that is cool because then we can use it. We can use this distribution. You see, this is what this um, indicator does. It calculates over a moving window what the distribution of these events is, and it's tell you how likely it is that we are in a certain region. So darker the color is, less likely it is. Like for example, if we and this is not repainting or recalculating after the fact. It's all live. So imagine we were close to the top, right? And you will not be able to see what comes next. But imagine you see everything else on the left, right? Draw a curve with draw a line, everything on the left of that line. You will see that this white curve, right, the price, it starts to go in this region that is darker than the other ones, right? And by the time you go to almost basically black, it means that the price is not going to stay there for a long time because it's too far away from the mean. And so it's going to have a correction. And you can see it's actually predictive. Yes, you're having a correction. So it's not going to tell you exactly where the top is, but it's going to tell you, look, this region, we are probably reaching the top. And so, you could take actions. In fact, you don't have to guess exactly where the top is, but as we come closer and closer, you can start to take action, right? So things that you can do are, so we are, you see, right now we are not even back to the red region. Even when we were in the red region, we are actually below the mean value, simply because we just started the bull run. But if we continue and we go back in the red region and then we cross the red line and then we go up, and by the time we are there, right, we made this prediction of 200K based on the decay of these tops, but we will start to see things like this where the colors will start to go darker and darker, and that will mean by the time we start to go to, there are basically 6 different levels. So by the time you can even put some numbers if you want, like in the contours, but you can see visually where the darker colors are, right? So by the darkest shading will correspond to, okay, in the next few weeks we are going to have a correction, a major correction. So that means that by the time we go in the darker area, we can start to take action. So one action is you rebalance your portfolio. So some people don't like that because they will never want to sell their Bitcoin, but it does make sense to keep all the time some cash, right? Maybe you should never be like 100% Bitcoin. Always in your portfolio have a little bit of USDT, because if there is some major correction, you can always then use that USDT to buy Bitcoin during the dip. And if we are ready for a huge dip, maybe you want to sell some of your Bitcoin. And it's never like, oh, you're selling all your Bitcoin. We never say that. These are the people that don't understand what we are predicating. We are not. They don't understand our position, so they want to make fun of us. Very unreasonable. It's kind of a caricature, because I remember, for example, when Plan B was saying, "Oh, by February," he was predicting that by February we were reaching 200,000. It didn't happen, and according to him, when we reach that value, we sell. We never say that, right? It's all a question of timing, deviations. Then we never sell everything. The idea was consider a certain portion, think about ahead how much what portion is. Is it 5%, 10%, 20%? I would never suggest to sell more than 50% of your Bitcoin. Of course, if we knew 100%, yes, we should have sold in January and rebought at 75 or 72, whatever it was, the bottom. But, we don't know that in advance. Um, so it's a reasonable thing to expect that by the time we have these large deviations, there will be some major correction. Now, do we go back to follow entirely this cycle logic where it takes 1 year to go down to the bottom? I it will be interesting if we revisit this white line, right? If we go back to the white line, and it takes 1 year, we already calculated that it will be around 70K. So we will go all the way to 200, go back to 70K, and if you sold some of your Bitcoin, then bought it there, it will be very good. You immediately multiply your Bitcoin. We don't know, because we had a couple of days going up, and we are saying, oh, we go back to the old way of having cycles, etc. It's too early to say. How it was too early to dismiss the entire idea that we didn't have a cycle, even if we stayed too long. This never happened before. We stay so long below the power law during a bull market. It's the first time. But too many people started to scream, because this is how it is, right? In this community, people jump immediately, like It's like, oh, squirrel, squirrel, like whatever, right? So many people say, oh, the cycles are dead. I don't know. It's too early to say, and it's too early now to say that we go back to a cycle. So let's see, right? By I think first of all by July we should have a much better picture if we are in this if we are following the liquidity. We will see where we are. So in fact, that will be kind of a critical thing, by June, July, to see where we are, reassess the situation. By power law alone, we should be on the 130 anyway. If we simply go back and follow the power law, we should be back to 130 by the end of the year. Hopefully we do arrive to 200. And do we have a correction? I think so. If we reach that, it's not just a number, like I say, everything together. But the other thing that we could do is to start to play with options. In fact, I want to start to play with option, and I have been playing with options um, in the last several weeks. And this is one of the things I want to discuss more. Maybe we can have like at least one weekly meeting where we dedicate it completely to options. So I'm going to have more structured material like videos on YouTube, but to explain you all the ideas. But we can discuss it, and I know that some of you do. Log Pilot is very good; he has done very well, and so maybe we can have him coming and giving us some ideas. But so the idea, the general, just to give you a feeling of how to play with these options. One of the things he's doing is he does this game between covered options and calls. So right, there are calls and puts. So basically, the name calls is when you're open, you're thinking that the price is going up, right? And so if you are anywhere else than in these very restrictive countries like Canada, United States, I think even England, you have a lot of restriction. Like for example, I don't think you can buy options um, directly with Bitcoin, but now we have iBit, we have MicroStrategy, so that are linked with Bitcoin, so we can use these tools, right? So we can iBit and Otis is much less volatile, so it's such a little bit maybe for beginners is good. And so if you are in the United States, you can open a Robinhood account that allow you to play with the iBit options. Same thing with MicroStrategy if you want to maybe try first with iBit because it's a little bit more because with the volatility come opportunity, but it's also more risky, right? While with iBit it's less risky. But so some of the things that we were doing right now, mostly because the idea was the price is not doing much, it's not moving very much. So if we could find a particular price where we think the um, we are not going there, and you're always thinking a certain time ahead, right? Like with this first, so there are two components to this approach that we can explore more, but I want to give you a feeling. So you do cover options. That means you're you're trying to sell the right to people to buy your underlying asset. In this case, iBit, right? And you can do it in two ways. You can, if you just do the cover options, you need to have the asset itself. So let's say, for example, you do iBit, you need to have at least 100 shares of iBit. And then you say, okay, I want to sell the right for people to buy these actions, to these shares to a particular price. And so you can come up with a price, and there is also a deadline. And usually, when you do this, you don't want a deadline that is too far in the future, maybe a month. All right. Okay, so and we can see, maybe next time we can meet again maybe on Friday, because I will be busy with videos and so on. But so Fridays we can talk just about options, and I can show you very concrete examples, and you can actually follow me because I will set up some of my options, and if you want to follow me, and again, let me do always the same disclaimers. This is not financial advising. Um, it's sharing my experience and the knowledge and learning. So do all your own research, trying to understand these things. But I can show you what I'm doing, and then you can learn from it. But so the idea will be I'm going to do two things at the same time. I'm going to do these call options. Call option means even if right now, right, there is all these spike in activity, etc., I can still come up with a price where I'm thinking, I don't think that within a month we go there, right? So you come up with a price, and we have these new tools, like for example, we have this new indicator that tell us the distributions based on the deviations from the power law. So we can look at the stream of a distribution. We pick up a value that we think is kind of far off from where we can reach within the next month. Then we sell the people the right to buy our shares at that price. And you will say, who's going to buy that? Well, there are some people that do, because if you come up with a price that is relatively far away, but not crazy, right? It's always a question of balance, right? If you do it, you can choose some price far away, and then nobody will buy, right? So if you say, oh, I'm going to use a Bitcoin price, but you will have to translate to IBIT price, right? But it's an easy translation. I can also show you how to do that. Uh, it's it's not difficult because the price of IBIT is what, $50, whatever it is, $52, and Bitcoin is 93. It's going up. It's so cool. But we can translate it, right? So, but let's say I'm thinking with Bitcoin, and you can also do directly with Bitcoin if you're an IBIT, right? You don't have to do it. Sorry, if you are in Bybit, uh, you don't have to use IBIT to trade Bitcoin. So anyway, imagine I say, oh, in a month, I want to sell the right to people to buy Bitcoin at 150,000. Very unlikely in a month we go to 150,000, right? Probably I don't find any buyer, so it's not worth it. You have to find something that you are taking still some risk, right? That we do there, and then actually we go higher than that, and then you're selling Bitcoin at a lower price, right? That is why it's attractive. Some people think, oh, you want to sell me the right of buying Bitcoin in a month at 100,000? Sure, I'm going to buy. So they are taking that right to do that, right? Because they think that maybe the price goes to 110, 115, right? And now they buy from you. You are forced to sell them the share. If And this is why many times these covered calls require you to have the asset. But there is one way where you don't have to have the asset that I will discuss in a moment. So if you have the asset, you have the shares, then you will have to give them the share. In fact, the exchange blocks you from selling away these shares because they are kind of frozen in the case the price goes to where you give the right to the person and they buy at this lower price, right? And what do you get by doing that? Well, you get a fee. So they pay in advance the fee to get this right. And farther away is from where the price is right now. So there are two things that they decide what are these fees. One, how much time there is, right? More time there is, more people are willing to pay because there is more chance for the price to go there. And also the other thing that determines the price is how close you are to the current price. Because you know if you giving them the right to buy them in a month from now at a 94, for sure they are taking this thing, right? Because maybe tomorrow we are at 94. So These two things determine the price. So you want to find a balance, right, between the price not being too far away and um, not looking, not giving too much time for the price to do that. So, but not too close, because again, it's easier to predict things that are close to us, but it will you will get less fees, right? And we can discuss. There are people that calculate these things. We can even come up with some kind of calculation of how to calculate these things. But right now we are going to use tables and do some kind of rough approximations of this, right? When we are doing now, it's better to do that kind of little game when the market is kind of flat, right? Like he has been. So it was a perfect thing to do during. So this is actually something that I would like people to learn, because many times we are bored, right? When we have a market, and this what Bitcoin does, right? There are many times where we don't do very much, we move very slowly, we are kind of flat, like we have seen in the last several weeks, if not months. And during that time, many people, they lose interest or whatever. And there are things like this where you can do and in fact make money that then you can use to buy Bitcoin. Some people immediately buy Bitcoin with these fees. You get the fees when you buy Bitcoin. And so it's a way of getting involved while Bitcoin is not doing much. Now, it's a little bit more of a risky game when we have something like this. So maybe we want to suspend doing this cover call during time when we see the price shooting, or maybe we need to be a little bit more careful. We can think about it. Let's discuss on Friday about this. Um, so at the same time that you do this, you can also buy the calls, right? In particular, if you're thinking uh, like right now, that we are going back to kind of bullish behavior. So you buy the calls, and these calls, so the call, remember, in this case, you instead of selling them, you are buying them, right? You say, what does it make any sense? I'm selling and buying the same thing. No, because again, is where the price is and how far the deadline. These are the two main things that determine uh, how to play with these options, right? So in this case, you will buy something that is far away, like for example, Log Pilot, and we can even look at some of these. Um, I can share with you what he was showing us on the Discord channel, right? On the general channel. Um, but I wanted to keep the chart, so I can tell you though. I can. You can look it up yourself, right? He was posting. Go to the general channel and see what he was posting, right? Let's go there. So he was posting some of his positions. Hopefully he doesn't get mad that we are sharing. I guess not, because otherwise he would not have shared. But for example, just one example. He has. I'm going to post it in the copy image. I'm going to post it in the chat now. In our voice channel chat, so you can see it. Okay. So look at this. Right, so he has three, right? So these are all calls. Remember, calls, it's the right to buy Bitcoin at a certain price, right? So he bought these ones. So they notice one of the first. So the first thing to notice is the type, right? These are all MicroStrategy. MicroStrategy is linked to Bitcoin action, but it's much more volatile. So, for example, if Bitcoin changes 2%, 3%, 5%, these that is what is alluring to people, because, like for example, I bought IB that is even less um, less volatile than MicroStrategy, but much more volatile than Bitcoin. And Bitcoin went up like 4%, 5%, whatever it is. I made 45% in a few days. And look at these gains here. These are all gains. 144. I don't know if these are total gains or what, or today's gains. It's crazy, right? 400%, 300. These are how volatile these things are, because the price goes a little bit up, and basically you have a right of buying these shares at this price, right? So the $400 is the price that people are willing to give you this share for. And then the other thing to notice is the date, right? This is the deadline. So it's 12 a month, 19, right? So by this time, when this thing expires, you will have a right to buy these calls, to buy these shares, this amount of share. Every contract is 100 shares. So here is 500 shares because there are five of them, five contracts. So you can buy all these shares at this price. And right now, what was today's price? Anybody knows? I didn't check. What is today's price for MicroStrategy? You can check it out. MicroStrategy. Uh, which one? Tell me again. 300 for yeah, $340, right? So you can see it's a higher price, right? Because it's $400. But so you say, why do we like want to buy at $400? Because it's only $60 different from now, and it's in January, right? You're saying, oh, I'm willing to wait all the way to January to actually buy it, right? And so in a good day like today, where we are bullish, the likelihood that it's going to go to $400 in a few months from now, it's improving. And this is why this thing went up all these. I think these are actually today's gains. By today, he made, I don't know, we will have to check. But, it doesn't matter if it, whatever it is, the total of today. This, this guy made 124%, and the other one 400%. You see why 400%? Anybody? Because it's closer, to the current price, right? It's and the date is even further anyway, so it has even more time to go there, and the price is even closer. So and it depends also when he bought it, right? Again, depends about maybe he bought the because you will say, well, how come the 301 that is even lower, right? If it's lower, whoa, it's even lower than the price today, so it's really valuable, right? But probably bought it more recently, so this is why he didn't appreciate that much. Otherwise, if it were bought at the same time, the 300 call should be more valuable, right? Because it's even lower price, right? This will be valuable even now. You could exercise it, and this person will have to sell it to you at this price, right? Um, but anyway, so um, the beauty of these calls is that it's not just your right to buy these things at these prices. You can also the options themselves are valuable because you don't have to wait for the deadline. You can sell it at any time. Uh, so you can trade them. Like for example, I did sell mine because I'm still learning, and I thought, oh, okay, I made 45%. You know what? I'm selling it. If I waited and tomorrow the price goes up, um, it will have gone even higher. But remember, you're also fighting against the call. So you're fighting against time, right? Mine was, I think, June or July, so I don't have much more time. Things like these that have very far away expiration time, uh, time is not too much of an issue if you're not too close to them because it doesn't matter too much, right? If 2 or 3 days pass by because we are still so far away from the deadline. But if you have something that expires more closely, to today, the decay, how fast they go away, right? Because this 400, if I imagine this 400 core, right, was in a month from now or to 15 days from now. First of all, it will be much less valuable. But if we don't reach that value by that date, then it's worthless, right? But the reason why it's so precious, right now it has a very good value, is because there is time for reaching that price, right? And we had a couple of good days, so it's going up. So these are some of the things that are good. And the nice thing is, if you buy a call like this, because you have a right to buy the shares, it's considered equivalent to owning the shares. So, see, the good thing is this, right? If you need to buy 100 shares of IB, or MicroStrategy in this case, you will have to spend $42,000. It's a lot of money for a lot of people, right? You have to spend all this, right? Because to do the cover calls, remember, is what I was telling you before. In that case, you are selling the right to somebody to buy your shares at a given price. Um, and I will explain in a moment why you want to do that. Why you could do one, the other, or both, right? Why both? The reason of why both is if you time it correctly, if you do it correctly, you don't have to spend $42,000 because first you will do this. First you will buy the calls, okay, order of operation. So first you will buy the call, and you will buy something that expire something like this that expires several months from now. Can be at a minimum maybe July, August. In fact, good idea to do it even at the end of the year, maybe even next year, early quarter one next year, and a price that is relatively close, right, to where we are right now. Now, of course, if you can do this during a dip when everybody is pessimistic, etc., because this is where he made the money. He bought it when we were reaching, close the bottom of the year. If you can do during times when the price is bottoming, it's much better, right? So right now it's a little tricky because we are going up, right? So we're paying a lot of money for these things. But if that is what is going to happen in the next few months, we will have to deal with that. And so, if you play correctly, what happens? You do this, you buy these calls, you're making money because the price goes up. At the same time, you do also the cover. The cover now is going to be a little bit tricky because, like I say, we will have to find the right amount. It still gives us some decent fees, but we are not risking to be in this position where we need to sell our shares. Um, in that case, what happens if it goes well for you, where the expiration date comes and the price is not reached, you got the fees, you bought Bitcoin with it, and you're accumulating more and more money because you can do it every 2 weeks, right? You can do this every 2 weeks, choosing a deadline that is not far away, and you do it every 2 weeks, and you, even if you make a small amount of money because you're trying to be safe, right? So you maybe making few $100s, you're making few $100 every 2 weeks, to the point where ideally all these fees make up the money for you to actually buy the call. So by this time, sorry, to buy the underlying asset, right? So by the time there is the expiration date, you can actually exercise it and then buy, because you need to see here you have only the right, you bought only the right. And what did you pay for this right? You paid whatever you paid, whatever the cost of this thing was, multiplied by 5, right? So right now, if you were doing it right now, we can look it up. So I want to do this more in detail Friday, but whatever the price for this right is multiplied by 5. It is not going to be $40,000. It's going to be much less, right? Of course, the day that you want to exercise means, all right, now I want to actually go through with my right. Sell me these shares. So you need to have the money to buy them, right? You can sell instead. So if you don't have the money, in other words, it's basically some kind of a leverage, right? You can pretend that you have the money to buy 500 shares of MicroStrategy, that is for $200,000 or more, even if you don't have $200,000, because you buy the right and then you sell the right? But if you do have the money, then you could buy this. In particular, if you're thinking long term, imagine maybe you don't care about owning MicroStrategy shares, maybe you do. But let's say you do this with Bitcoin, then whatever this applies also to Bitcoin. So imagine you bought the right to buy Bitcoin at 110,000 by December, and then we go to 200,000. Can you imagine? When you do exercise, and maybe because of this selling of a cover call, you actually have the money to actually buy, and $100,000 worth of Bitcoin, and maybe you didn't have it before. You accumulated through the sale of these cover calls. So this is one of the things you can do, and like professional people that know how to play with options know how to do. So I would like to explore this with you because these are some of the things that you can do in addition. Again, it's a little bit more advanced. Some people don't want to spend the time and energy to do this. They just want to hodl, and it's perfectly fine. It's just that there are many ways that we can be Bitcoin hodler, right? We can do it passively, but we can also do with a small percentage because still the best advice is that at least 90% of your holding should be just not doing anything. But you can take a small percentage, 10, 15, 20%, and trying to do something a little bit more active, right? Because not everybody owns 300 Bitcoins, 500 Bitcoins, right? You want to have more Bitcoins. And these are some of the things that we can do. Now, talking about the top, what will you do? Well, we will not go with calls. We will go with puts instead, right? But we can talk about that too. Puts in this case will be basically your hoping for the price of Bitcoin to go down because basically puts give you the right to sell Bitcoin at a certain value. So in this case, imagine we know that we are coming close to that peak of 200K, and for whatever reason, all the information that we have, etc., we will have to decide, see how everything moves, all the things. It's never a decision based on one single number. We will have a lot of different information coming together. But imagine we are coming to that date and everything converges where we believe there is going to be some major correction. Then we say, okay, I would like to have a right to sell Bitcoin at 200K and 2, 3, 4, 5 months ahead of time, right? Maybe even 1 year ahead of time, whatever period we want. Um, and we buy that right, and it's going to cost something, right? Several $1,000, a few $100, whatever. How many of these rights you want to buy? Well, then there is a correction, and these things start to be more and more valuable because people would like to have it to sell Bitcoin at a much higher price, when actually the price is correcting. And it's going to be a way to compensate for some of your losses because now all these Bitcoin that you are still holding go from being $200,000 go down all the way to 70, and so you don't have to sell them, or maybe you can do both, right? You can sell a little bit, you can buy some put options, and the combination of both is almost like an insurance, where you're protecting yourself. And then when we reach the bottom, before you reaching the bottom, for sure you will have or exercise the option. That means you actually take this right to sell it at that value, even if Bitcoin is 100,000 or 70 or whatever, or maybe you sell the contract before, right? Because people will buy from you given that it's valuable. Um, so yeah, so these are some of the things that we should explore. So let's try to meet on Friday, and then we can look at some concrete examples, etc. Okay. Do you guys have any questions or any comment? Okay. All right. So let me know. You can always DM me if you do. All right. Okay. Otherwise, enjoy this rally. Yeah, Sanders, you were going to say something. No problem. No problem. How are you? Everything fine? Yeah. Yeah. I hope you to see you in Amsterdam. I'm actually planning to come to the conference when we are going to have it. I don't know. Where is it usually in October or something? When do to the conference? It's usually during that time. Yeah, I was actually invited in Bulgaria, in Sofia, for being a speaker. So I'm trying to. I think it's all around that time, and I'm planning. So um, if it is around that time when there's other conferences, I'm coming to Amsterdam. So maybe we can meet. Fantastic. Very good. All right. Okay. See you soon. Let's have this discussion on Friday where we can go more in the details of how to play with these options. Okay. Bye, guys.